Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high-yield investing, as well as futures, options, and really investment goals in general. If you're new to the channel, welcome. To give you a little bit of background about what we're doing here, I took about a quarter of my net worth, been experimenting for about the past year and a half with high-yield investment strategies, and I have built what I call an all-weather high-yield portfolio that I have called Cash Flow Life here, using both my own capital as well as some margin to pay all my bills, as well as maintain and pay down that margin over time while I dollar cost average back into the strategy each and every market day. Please hit like and subscribe. Please help support the channel. Everything we discuss here is not investment advice, not now, not ever. So please do your own due diligence before making any investment decisions. What I want to talk about in this video, a couple things. The main thing I want to talk about today are just some really high yield investments, what I call ultra high yield investments, and look at some of those, my thoughts around those ultra high investments, and talk about what's coming this week, at least what I think. And again, all of this is my opinions only, so please keep that in mind. So what I want to talk about kind of right out of the gate today is just some of these really ultra high yield ETFs out there, your ULTIs, your ULTY, your ULTI, and KYLD. Now, I have owned ULTI, ULTY. I currently own KYLD. I have never owned ULTI, but I want to look at each and every each of those three in detail, just kind of break them down and give you my thoughts around those. Now, if you have a high yield strategy like Cash for Life here, I think that these ETFs can be a very valuable tool. Please know, I would say right out of the gate, I would never, ever put all of my wealth or even a large part of any cash flow strategy like here into any of these ETFs. Starting off with ULTI, ULTY, this is one of the most popular ones by YieldMax. This one currently on their website yields 65.97%. We can break this one down a little further. I don't love ULTY, but I also don't hate ULTY. My experience with ULTY, I've owned it off and on a few times already. And what I found is that it can do the job that it's meant to do, meaning it can really kick out a lot of income for the portfolio, for the strategy. But it does suffer from severe NAV erosion. So much so that over the past 4 or 5 months, YieldMax has had to change their strategy throughout ULTI, as well as do a reverse 10-for-1 split. Reverse splits, they're not a big deal. Usually it's, you're just trading in 10 dimes for $1. That's really all it is. But the fact that, margin requirements went up temporarily from 25 to 70%, it's just those nuances that really kind of can start eating into a strategy or a portfolio. So ULTI's had a tough time. I bought ULTI back in April, right towards the end of the whole tariff tantrum, Liberation Day, whatever they call it. I bought it, and it had really good, solid NAV stability from about April till right into August. And what happened was it looked like it started succumbing to the same issues it had previously, where the NAV just started really declining, right? Where the distributions weren't even keeping up with how much the NAV was going down. So that's a little frustrating, right? I think a lot of investors, especially in the high yield space, get really enticed by 70, 80, 90% yields. When ULTI first came out, it used to yield monthly, and it was paying triple digits. It was paying like 100 to 130%, somewhere in that range, usually in distributions. Well, the NAV just got clobbered, right? It got hit hard. And YieldMax has had to make some changes, a few changes to it. How they go about it. They had to start finally buying puts, as they sold calls, just to hedge the downside for a lot of their holdings. I'm not sure what the managers, how they sometimes choose or chose some of their holdings for ULTI. You can look here, we can scroll down. Currently, again, Robinhood, I was on their site. I know they are currently, as of today, saying they yield 65.97%. Most of that is return of capital, which is nice. But seeing Palantir and NVIDIA in there, even Broadcom, seeing TLT and, GLD, GDX, that's pretty new, right? ULTI has held Robinhood quite a bit. Jabo Quanta, some of these other smaller names, but it looks like they're changing into some more stable names versus what they've done in the past. Now, what I've always found interesting, and again, I'm not saying I could pick it any better than anybody else. I'm not making that claim, but it seemed to me like with ULTI and SALTI, a lot of the managers were picking, individual names, for example, ULTI that had already gone up. So that in my mind, they were kind of late to the party. So if something just rallied really hard, I felt like you'd suddenly see it in ULTI, right? Or if something fell hard, you suddenly see it in its inverse fund, SLTY, SALTI. That's not really how I invest. And again, it's no knock on the managers, no knock on anybody investing it. I think that these are good ETFs if you use them in the right way. But that's why I sold out of ULTI, sold out of SALTI. They just were not, allocating in the strategy that I thought would be best in my own opinion, right? So I've been out of these for over a month now. And what I did notice was that ULTI and SALTI, though they do a great job of producing high income for paying down and maintaining margin, I started seeing both NAVs erode a little bit more than what the yields were covering, which didn't set well with me. So maybe I might buy back into ULTI, ULTY. We'll see. Do a little more research on kind of what they're doing, their new strategy, see if it's become a little bit more conservative. Their yield has fallen to about half of what it was when they initially started, and for good reason, right? I think they're starting to get more exposure to some better quality names, which is going to mean less volatility, which is generally going to mean less premium, right? So less that they're generating on the premium side to distribute to shareholders. So, but again, ULTI does pay weekly. I think there is a place in high yield portfolios for it, especially if you're on the long side. I do like the better exposure that they've been doing at YieldMax overall with ULTI. So I think this is one that I'll probably own off and on depending on market environments and my cash flow needs as we go. So I want to talk a little about ULTI. We'll also talk about ULTI, which I guess we can't also call ULTI. That caused some confusion. So Rex Shares came out with ULTI. This is their ULTI ULTY equivalent. Now, what's interesting about ULTI, it listed in, I think it was October. I think it was Halloween, actually. Yeah, October 31st, they listed. And about $26 a share. Now, in that time, we've had all of November, all of December. So let's call it 2 full months, right? And this sucker's down 41%. Now, that does not include the distribution. So again, this is another thing with Robinhood and other brokers. P&L, total return, it's never accurate because you have to factor back in the distributions to get total return. So that's why I don't like this. However, 41% is quite the fall, in that amount of time, considering that they're currently boasting a 78.3% yield on their website as of today. So, you take 1/6 of that, that's really not covering what it's lost. And I've seen this sucker swing 5 to 10% in a day up and down. So what I think ULTI is, it's very similar to what ULTY used to be, right? A lot of volatility. We can look at some of the names in here. You're getting, again, a lot of more meme names, a lot of just more volatile tech companies, right? In my opinion, less diversification than what ULTY is currently doing. So if anybody liked the old ULTY strategy for just really high income, I think ULTI is probably going to be the way to go. I have not owned this. I think I said that earlier. I don't plan on owning this anytime soon. I might in the future. But to go from, down $10 a share in 2 months, no, thank you, at least to me, at least not right now. So Rex Shares, I think they do a decent job overall on a lot of their ETFs. This is one that I'm just not really right now. So yeah, it's going to get a little higher yield right now than ULTY, but I think with, in my opinion, a lot more risk. Okay. And again, volatility is nothing you should fear, nothing you should shy away from, especially if you want to, minimize risk and use options to minimize risk like I do. But again, this is a lot more aggressive than the 3 ETFs that we're going to really pick apart today. So I think their maintenance, yeah. So they did bring down their maintenance to 25%. It was at 100% the first month or two that it did come out. So I really don't like to buy ETFs with 100% maintenance ratio. It just eats up all the equity inside the account. But just like ULTY, it is a synthetic, covered call strategy. And again, really high yield, very high risk. Last one I want to look at is KYLD, and why I currently like this one the best. KYLD is one I held off on until their maintenance ratio came down to 25%, like you see here. I like how it's currently allocated. I just bought 500 shares last week of this ETF, and it's got some miners exposure. It's got your memes, it's got your smaller tech, but it's also got some AMD exposure. Last I looked, it had some other big names like Intel, Broadcom. And again, remember, all three of these ETFs will move certain holdings in and out based on what the managers feel is the best, I guess, risk return through the holdings that they can find at the time. So the main thing I like about KYLD, as of today, they were boasting a 37.83% yield on their site. So it's going to be the lowest yielding of the three. However, what's interesting is it listed the same day as ULTI, right? As Rex's ULTI. And what you've noticed is that it has fallen, instead of 44%, it has fallen 15%, right? Now, even with the smaller distribution, this is still a much better, NAV erosion scenario than we saw with ULTI. So I think with KYLD, a roughly 38% yield, which I'm borrowing at 4.5%, making 38% on KYLD, I think is a good trade-off. If I can pocket that 33 to 34% yield, that's great. Yeah, I know I'm going to get some NAV erosion along the way, but if I held it for a little over 2 years, and I can get my money back through distributions, I'm happy, right? Again, KYLD is a holding I'm going to hold through 2026, see how it does at the end of 2026, and see if I should add more or just sell out, right? Or just keep what I currently have. I might add, there's a small possibility I will add 500 more shares of this. We will see. But as of right now, I just put in an order to buy 4,000 shares of YQQQ at market open tomorrow. So just want to see where everything stands after I, make that large purchase. That's going to be right around $50,000. So of the three, of ULTI, ULTY, KYLD, I really like Curve's high income ETF. Sure, you're getting a little less yield, right? So if you like those ultra high yields, this is probably not the one you choose. But I think if you want to maintain better NAV, okay, I think through the long term, at least right now, again, these funds have not been out a very long time. Keep that in mind. So again, KYLD, I think will do the trick when it comes to a solid 38% yield as of now. Far less NAV erosion than we've seen. And so, again, we haven't really seen a lot of volatility, right? Usually higher volatility means higher distributions. So even this low volatility environment, I think the VIX last I looked was right around 14. So again, very low, right? And so we'll see what it does when and if volatility picks up in 2026, as I expect it to do. This week coming, the biggest news, I guess, is Venezuela, what's going on there. I think the markets have already priced all of that in by now. We might see a little bit of it in tomorrow's markets, up or down, sideways, whatever. I know oil was down slightly, nothing crazy, about 0.5% in when the Asian markets opened. So again, if it's already in the news, I think that's the best time to buy when there's, catastrophe. I always joke, because I'm buying such a large chunk of YQQQ, the markets will probably go up this week. We'll see. I think we'll probably have a flat to up week. I'm not going to try to time anything. That's not my specialty. So I'm going to buy a YQQQ. This is the first day tomorrow I can buy it back and not trigger a wash sale. So I'm going to buy it. Have that hedge also through 2026, just like the KYLD. And what that's going to do, that's going to hedge me if we do have a 10, 20% sell-off. It's going to be a nice added balance to all of the long positions I have. Because keep in mind, the QQQ and SPY, those long leaps puts I have are 20% out of the money roughly. So those aren't really going to kick in until QQQ hits $500 and SPY hits $550 and below, right? So what I like about YQQQ is it'll pay me weekly, and it will kind of help hedge any potential downside that we might see this year. And I think we will, right? I really think 2026 is not going to be like we saw the past few years. I think there's a potential for a giant market collapse over the next 6 to 18 months. So we'll see. Anyways, want to share my thoughts around those 3 ultra high yield ETFs. Again, WPay and YMAX, they are my ultra high holdings right now. They're doing the job they're meant to do. They're going to experience yield erosion, yielding right around 1% per week. And again, I call anything that yields more than 1% per week on average, or more than 52% annually. That's when you get in your ultra high yield space. Okay, a WPay and YMAX right now are right around that cutoff. They're right around 50% annualized. So I like those two. I'm going to keep holding those two, keep dollar cost averaging back into those two, at least right now. But love to hear your thoughts. Love to hear your comments. Again, please hit like and subscribe. Hope you got something from today's video, and have a great day.